Are you a Canadian temporarily working in the US and are wondering how you're going to be taxed? In this video, I will show you a strategy that will allow you to prevent or reduce double taxation while saving you money. Let's use an example. Vanessa works for a Canadian company in Ontario. The company is sending Vanessa to temporarily work for a client in Florida. Vanessa will divide her year of work by spending 8 months working in Canada and 4 months working in the US. The problem that Vanessa now faces is how her payroll obligations will be handled as a Canadian who is temporarily working in the US. She wants to know exactly how she will be taxed. Does she have to pay both Canadian and US taxes? First, we have to look at the tax treaty between Canada and the US. The treaty states that employment services are taxable in the country where the employee physically works. Since Vanessa physically works in both Canada and the US this year, she has to comply with both her regular Canadian payroll taxes as well as the foreign US taxes. This means payroll deductions from her income will be doubled. Her income will be taxed once in Canada and then again in the US. Payroll deductions in Canada come from the CRA and are derived from income tax, employment insurance, and the Canadian pension plan. Payroll deductions in the US come from the IRS and are derived from federal tax, state tax, Social Security, and Medicare. In this example, Vanessa makes $10,000 per month. In the 8 months that she worked in Canada, she made $80,000. In the 4 months she worked in the US, she made $40,000. Therefore, her total income for the year before taxes is $120,000. Vanessa will get a T4, or Canadian Employment Income Slip, reflecting 100% of her wages for the entire year. Since she makes $10,000 a month, her T4 will reflect a total of $120,000. Vanessa will also get a W-2 slip, a U.S. wage statement, for the earnings she made while working in Florida. Since she worked in the U.S. for 4 months, her W-2 slip will reflect a total wage of $40,000. The question Vanessa now asks herself is, what can she do to prevent this double taxation? Vanessa decides to complete Form T1213, Request to Reduce Tax Deductions at Source. By completing Form T1213, Vanessa's Canadian payroll taxes are reduced by approximately the same amount that her American payroll was taxed. This prevents and/or reduces the double taxation. With the T1213 filed, Vanessa's income is no longer being double taxed. However, she does not want to continue contributing to U.S. Social Security and Medicare because once her 4 months in the U.S. are done and she returns to Canada, she will no longer need to take advantage of these American benefits. Vanessa's employer obtains a certificate of coverage from the CRA, so she will no longer have to pay into Social Security and Medicare. Instead, the money is contributed to the Canada Pension Plan, which she can use for her retirement in Canada. By following these steps, Vanessa is able to relieve her income from the double taxation. Now she is left with more money in her pocket. So here's the tip. By following this strategy, Canadians temporarily working in the US won't be double taxed, giving them more access to their hard-earned money.